Excited. And we are live on Oz Property Wrestling. We bring names, and we have the late fun. It is 5 minutes late, but it's well worth the wait. Trust me. Joe and I were discussing about war, interest rates, but more importantly, the locations, because that's what, like it or not, interest rates are going up. You still want to know where to buy, and this is a pivotal session because we want to talk about, well, is there value under 650? Where are those sub 650 markets, and what's as well? Because where is one thing. It's easy to know a location, but what are those things? So, Joe, how are you going?
Mate, I'm fantastic. I'm very excited for this session. This is going to be one of these sessions where we, as an investor, like there's a lot of value in the 600, 700, 800, $1 million range of property markets. But the problem is not everyone has that. So if you're an investor that is just starting out, my first purchase was $280,000 because that's all I had at the time. So if you're just starting out, if you've got a portfolio that has 3 or 4 properties and you can't borrow anymore, but you can borrow 450, 550, 600,000, is there still somewhere that is worthwhile putting your money? That is the point of this session. So if you've got portfolio, if you don't have portfolio, where are the opportunities at $650,000? Now, some of these sessions, I would like to think we have education and entertainment, that whole edutainment stuff. This session is not going to be very entertaining. This session is going to be,
what do you mean?
Sorry to say, Jeff.
Incredibly entertaining.
It's going to be more about numbers, data, spreadsheets, and macro fundamentals along with micro fundamentals for this. So we're not even going to do intros, Jeff. This is Jeff Miles. He's from Level Up Property and also Step Up Loans. This is Joe Tucker. I am from Property Principals Buyers Agency. We do amazing sessions every single week. None of this is financial advice, Jeff. Do you want to pop that up? This better be entertaining. Oh, dear. Now we're getting in trouble here. No entertainment allowed here. None of this is financial advice. Oh, you say it, Jeff.
Yeah, I think I do because of the cop. So I don't have to. I feel like I've said it, and I don't need to say this. Any information, you should seek your financial advice from your accountants, your brokers, all those good people. So none of this. We're not liable for any cost, of course, from this. Any loss, not cost. But no, it's going to be fun because I was diving. Joe, how are you going today? Anyway, by the way, you going well?
A+.
Yeah, you're on the Kieran, not on the wild turkeys. But no, I'm excited. Look, I'm actually super pumped about the meetup Friday night as well. For those who can come along to Sydney,
very true.
I don't know. I'm worried that they're not going to be able to have fit enough people in the venue. Jeremy's coming as well. He's ringing me the other day. He's left, Jeff, what time are we getting there? He's already thinking about his entrance and exit, and Marcy and Ross from Adelaide. It's going to be a huge session. Steve might even show up. Who knows? But no, it's going to be fun, this one, because if you want a suburb unpacked, drop that in the comments because we're going to do in the Q&A towards the end, we're going to do the session that gets the suburb that gets pumped the most, not pumped, but I suppose mentioned the most. So if there's a particular area you want us unpacked, let us know and we'll do that on the fly. It'll be a quick high-level data analysis, but I'm excited for that. So, Joe, the reason why I think this session is going to be really interesting because I went back to so many people struggle with the area research and picking the location. And I was doing state and I thought, well, look, I initially I was like, okay, where am I buying for 650? Where am I buying for 650 and under? And I thought this is actually a little bit harder than I imagined. Then I realized and thought, actually, no, I'm constrained by my budget. So these are the locations, these are the type of assets I can consider in that location. So, and I just, it pieced together over time. So hopefully we can tell that narrative. Over to you, Joe. What's happening?
Why are we doing it? Let's jump in. One thing I wanted to just mention, just to make clear, there's a session where we're having beers at 7:30 at Cheers Bar on Friday. That's what Jeff was talking about there. This Friday,
not 7:30.
6 o'clock is it? Oh, 6 o'clock. Sorry, guys. I guess I'll be there. Earlier. Okay. Well, Jeff, one thing that I think is worthwhile, topical to hit on straight out the gates, is some pretty fundamental shifts in the property, in the Australian economy, in the Australian market. One, interest rates have gone up. Two, Donald Trump decided, like his fat fingers, decided to hit some nukes onto some people in Iran. And now we have a pretty full-scale war. What are your thoughts on how this affects the Australian property market? Big question.
I'm not sure it really. Obviously, what it'll impact potentially is the interest rates and inflation. So, as sad as an event, and I'm not an economist, and I'll do my best not to play on the internet. Jeremy is the GOAT on that. He was on last week. Go and watch that session if you want. a masterclass on CGT. My view, I suppose, I look at it mostly through the lens of borrowing and yes, potentially a little bit of what the flow and effects of the property market. So for me, I see that as, yes, interest rates will very likely go up again in May. I'm not saying absolutely 100%, but I'm saying it's a very good chance they're going to go up again in May, unless something ridiculous happens. So what's, I suppose, happening is you're seeing that inflation through the fuel pop through to the economy, which is then forcing to some degree the RBA's hand. So what will it mean for, because we'll talk about that throughout this session around some of the locations. So
Yeah.
it may dampen demand a little bit, but at the same time, will it also dampen supply? Because are people just going to say, look, I can't afford to go and buy elsewhere. I'm not going to sell my property. So is it a net positive, net negative? I think it's going to just roughly, people will have slightly lower budgets to play with, and they'll be competing for properties at roughly around the same prices and maybe even fewer properties. So I don't think it has all that big of an impact. But what are your views, Joe?
Yeah, I think it's giving people a window of opportunity to take advantage of some markets. So what I'm seeing out there in the, well, historically, let's just talk about it. 1973, we had a oil crisis. House prices across all the major capital cities from there surged between 34 and 83% the following years. 2008, we had a GFC. The share market dropped by 30%. House prices went up 6 to 12% between 28 and 2011. And then obviously COVID happened, right? Massive market crashes, and the property market crushed it during those times. So what happens is there's a flight to safety. There's a flight to safe assets. There's a flight to tangible assets. I would be a little bit worried if you're spending $2-3 million on your next investment property or your next purchase, because I think that as interest rates come in as well, that'll start to affect. But someone buying a $2 million property is going to drop down to 1.8. Someone buying 1.8 will drop to 1.6. And it gets to a point where you can't, carry that on. And also the other thing is inflation squeezes the supply, right? So that is going to make the supply chain harder to get materials to be able to build properties. So that's an interesting one to watch as well. So I think it's an interesting opportunity, but I wouldn't be heading for the hills because it doesn't change the macro fundamentals of the Australian property market, where an area has too much demand, not enough supply, which are some of the areas that we're going to be covering off tonight, guys. So we're going to be covering later on in the show how, where to buy, where to actually buy, where are the property locations that are actually worth buying and putting our money into. Okay, I'm just going to share my screen, Jeff. I'm going to have a little bit of a chit chat, and then you jump in with your sweet insights and give me your thoughts, because I created half a presentation here, and the $650,000 dilemma. Capital city townhouses versus regional houses, the smartest deployment of capital in the Australian property market, because that's really, if you're at the $650,000 mark, and you have to get a somewhat decent yield, so like 4% plus, then you have no choice but to go regional or get a townhouse and a unit. You haven't got much of a choice.
Can I say, sorry, Joe, there are a couple of capital cities where you can still buy for under 650 relatively comfortably. And the yield, yeah. But so sorry to steal your thunder there. I mean, look, let's just say the major capital cities. I will say the major. So we love Darwin, we love Hobart. You can still buy there for under 650 pretty comfortably.
That's true. Yeah.
But not Battery Point and not Nightcliff. You're probably, unless you're buying a unit. So I agree with Joe. Yeah. So but yeah, I just wanted to
there's 15,251 suburbs in Australia. There's 13,699 that have somewhat reliable data. There is 1,740 that have high confidence in their data. Overall, have high confidence, which is enough data for you to make an educated decision on the purchase, right? So there's only 1,700 suburbs that you can choose from at any one time. Yep. When you break it down to 650 and below, there are 244 suburbs. available for you to go out there with reliable data. It doesn't mean they're good areas. You have to then filter that even further. But I thought that was pretty interesting. So from 15,000 suburbs down to 244. So I guess the point of saying that is you've run, like, you don't have a lot of choice. There's not a lot of options out there, $650,000 and below. Yeah, so I just wanted to bring this chart up because I think it's pretty interesting, because this is capital cities by value and segment. So we don't have this for the regional market, but what this chart is done by our guys over at CoreLogic, RP Data, or Cotality, and what it shows is what is the capital growth over a percentile of the market. So there's the lowest 25%, which is the orange. Yellow is the middle 50% of values, and then the purple is the high. So if we have a look at Melbourne and Sydney, you can see the high part of the market, the 75th percentile and above, has actually lost value. So if you bought a $3 million property, that would now, a year ago, it now would not be worth that. It would be worth 1.6% less. But what you're starting to see is these bottom end of the markets and the middle tier of the markets are absolutely on a tear. So I think this is where it's very, very interesting. And you will start to see this shift again with fear and uncertainty with interest rates as well. People will drive to the unaffordable, so the affordable parts of town, rather than getting on the expensive ones. What are your thoughts, Jeff?
Yeah, so for me, I thought about this in many ways, because in the past, I must admit, I've changed my mind about villas and townhouses. I bought one townhouse in my time, and it did nothing for 5 or 6 years, and then it subsequently grew. So I think, to your point about the affordability and about being squeezed and prices, particularly in capital cities, just becoming largely unaffordable for the investor and even maybe the owner occupier, I think that is where we're starting to see those lower price points and the other asset classes coming into their own, particularly where it gets so as expensive to build. What I wanted to say about this is this will come down to, okay, we assume you've already got your brief sorted. Where you're looking at in the portfolio will dictate the lower value you may need to buy at. And these markets are going to be very competitive, as you're seeing there with those numbers on the Cotality sort of things. There is a lot of interest in the lower price point. So we are going to mention there's a couple of capital cities that I've looked at. In fact, there's 3 capital cities where I've got, and 2 of them you can actually get some houses in there. So yeah, go on, Joe.
Spicy. This is total listings over the years. So why is the macro fundamentals of the property market in Australia super interesting, and why are property prices surging? Because look at how many listings are available. We have been dragging behind over the past years, and you can start to see that. We're starting to get more listings, starting to pick up, but we're not even anywhere near the 24 and 25, which is pretty interesting. So compared to this time last year, listing volumes are down 14%. Over the past 5 years, it is down 17.8%. So that's one thing is, these big structural, these wars, the reason why interest rates dropped, why? Because of, is it because of unemployment? Is it because of, no, it's because of fuel. It is because the war caused the fuel issue. That fuel issue is going to last a period of time, but is it going to last forever? Maybe not. But anyway, it's just looking at the listings volume. I think I already kind of hit on that as well. The other thing to note is this is more of a note to the fence sitters. So what's going to happen in May? We spoke about this last week. What's going to happen during the election is they're most likely going to change the capital gains tax rules, which then doesn't allow the changes to negative gearing, changes to capital gains tax, but they're most likely going to grandfather it in. So we now have a window from today to May to get properties that are going to be grandfathered in to secure the capital gains tax discount. More importantly, at a 600, so the Australian capital growth has been 9.9% over the past 12 months. Everything. So all of it put together gives you 9.9. Regionals have grown 11%. So that $600,000 property at 9.9% is up 60, let's just call it $60,000, almost 10%. So every 12 months that you wait, every 6 months that you wait is $30,000 that you've got to save for more, or there's the lost opportunity of that. So I am just cautious of people sitting on the fence and not making things happen for a year or 2 years or 3 years. And it's not a bad thing. Like, you have to get educated. You have to spend the time to learn about property investing. But I just cautious people to not continue doing this, because as borrowing capacities compress, it does become harder to buy a $600,000, $700,000 property. But also, as prices grow, it means that the asset that you're going to be getting in a year's time at $600,000 is going to be completely different to what you could have got, today or tomorrow. Yeah. Okay.
And I suppose as well, the reason driving a lot of these changes and challenges is that, like, land in a lot of places, not necessarily the regions, but regions will sort of regions is going to be based on. But you look at capital cities, where are they creating? Yes, Melbourne has some good land available in various parts, but if you look at Perth, there's almost just no land available coming to market, and that may change. But for the time being, even to get a 250 square meter block of land, you're paying $300,000 for a block of land, and let's assume it costs you let's assume it costs you about at least $350 to knock up a sort of fairly stock standard, maybe 3-bedroom house, nothing special. So that's kind of what's driving. So if builders can't produce these properties, and if buyers can't sort of pick up these deals for, like, construct them for 700, what are they going to? They're deciding to pick up a villa or a townhouse or an apartment in these locations. I'm not saying apartment. So I'm going to talk to some of the challenges from actually buying these assets as well, because it's not all townhouses don't grow. What does it say, Joe? Truth is in the macro data. What does the macro data tell us?
I actually should say micro data, but I wrote it wrong. But anyway, so so one thing about the data for townhouses is units. There's houses, and then there are units, right? You'll see that. I think we've got have I got a totality report up? You'll see it all the time, houses and units. The problem is there is a big mix up with real estate agents, and the data just isn't captured. So a real estate agent will say, well, look, this is a 150, 200 square meter townhouse. It's pretty much a house. It's a 3-bedroom. That's going to be listed as a house. So it just isn't captured. This is a report that was done in Melbourne between 2008 and 2022, and you can look at the capital growth. They did the effort and broke it down by houses, townhouses, medium density, and high density. So these are the things that we talk about not to buy. We've spoken about it for many, many years. High density apartments are definitely a no-go. Medium density apartments, definitely a no-go. Townhouses, this is from 2022. This gap between townhouses and houses is going to start to close a lot faster. What's happening is there's a glass ceiling on funds. A market that's grown $1.1 million, a townhouse starts looking pretty good. So what you're seeing here is the disparity between capital growth. Houses have always outperformed townhouses, and they will always outperform townhouses. What we want, though, what we're going to see in the data is this compression because of the affordability of houses now. What are your thoughts, Jeff?
Yeah, I mean, it's played out if you look up in Brisbane, you sort of started to see even in places like Logan there's not as many townhouses and villas out in Ipswich and Toowoomba. But you saw it happen a little bit in Adelaide. You saw those townhouse values go up. Mm-hmm. I'm starting to see a little bit of it in Sydney now, because it's just insane. Some suburbs, and one of the suburbs I'll talk to, it's sat stagnant for a little bit, and even over in Perth now as well. You're starting to see the areas. Sorry, go on.
Okay, exactly.
Taken. Oh, mate, right next to Zilmi. I know extremely well. So the first property, it literally sat and did nothing for 5 or 6 years. And it's almost doubled in about 2 or 3 years. So it's went from about 350 up to now. Actually, it's more than doubled. It's gone up to about 700. And now the reason why that happened, you saw houses take off in that suburb. Now Tagham is right next door to a more affluent, sort of sought after area. So I imagine you're going to tell me a similar story in Tagham. In Brisbane.
Mate, let's just look at the data. Median value of a house is 1.16. It has grown 19.33%, and the rent is $720 a week. So that we don't need the yield. It doesn't matter. However, units. Now, remember, units get bundled into townhouses. So what you'll see is a jump between townhouse values being more expensive than units. And most likely the thing, I'm going to go out on a limb here, most likely the thing that's dragging up this number so much. So Tagum, the property market grew 21% for townhouses and units. It grew 19%. So townhouses and units beat Tagum houses, established houses in Tagum. What about Morley? This is a suburb in WA. I don't even think I loaded the page. I just assumed that this would be the same case. Go down to Logan, exactly the same. Median house price for units, units 32%. Median value for houses 30%. And then let's let Morley load, and hopefully I haven't messed this up. There you go. Exactly the same trend. 20% for capital growth, 23% for units and townhouses. And you'll see that the yield is much better than houses because of the rental return. Because typically these townhouses and things are slightly smaller. They've got less land content, which means that they're more affordable, which then means that the tenant doesn't really care if he's got a slightly bigger backyard. He's not going to pay an extra $250 or $300. So the rent doesn't keep up with the houses. So the yield, instead of being 4.9 in this example, is 8.3. I don't believe that. In actual fact, it's just going to be the averages. But it's interesting to see how that flows out and how it actually works from a data perspective. So when you look at things from a macro, yes, townhouses get the crap kicked out of them from a macro because it's included in with the units. But just know there's markets within markets and data within data, and you're not buying a median. You're buying a house in Tagum, or you're buying a townhouse in Tagum, and you're buying an individual asset that has the potential. A handy little reference point for you is like if you're looking at townhouses and townhouses compared to property prices, it's about 80%. So if you've got a house, times it by 80%, and that's going to be the townhouse value. And if you're looking at a townhouse, divide it by 80%, and that's going to give you the house value. So it's a little handy metric that might, it's a bit of a 20% difference is what I'm saying.
Yeah. I mean, there's Sydney is depending on where you're looking in Sydney, it's actually probably some suburbs I've found are 30 or 40.
Oh yeah.
Sydney's kind of maybe a bit of it's an anomaly. Let's talk to some suburbs because I did some. I think that's what a lot of people have come for. Now, what I'm going to say here is where we talk about, I will call out where we're talking about units and villas. I probably would prefer villas and townhouses where possible, because then at least you get a little bit more land content, because there's still typically more value in those land content things, depending on where it is. Potts Point, of course, going to be a little bit different. But what I will say is, though, where you're going into these type of assets, you really need to dig deep. You need to understand the costs involved and chuck that into your spreadsheet. You also need to understand sinking funds. Like, are there any special levies? Is there any issues with strata? Is there other arguments between? So there is a little bit more due diligence required with these suburbs. with these asset types, because if you get this wrong, and if you don't understand what's going on with who's who in the zoo versus a house, yes, you can still have issues with the building. So I'll just call it out up front. So the first suburb I wanted to talk about where I saw some potential value, and I'm going to do this in a framework. And then Joe's got Wagga as well. So I've just let that cat out of the bag. So sorry, Joe, you've been spending hours and hours on that today. But I'm going to say, okay, why have I picked this particular suburb, the quick data stats, and also then talk about concerns with the area, because I want to say, well, what do I not like about the area, and who it likely fits, because I think there's many different people that could potentially fit into these areas, but they do fit certain ones. So first up, I'm going to chuck in, we've got Mandurah and we've got Gosnells as units in Perth for under 650. Now, I did actually look online because I thought I don't always believe the median value. So the median value, so why I like Perth still for this particular asset type, because we've got a budget of 650 now. We're not buying So in terms of Perth, there's a chronic shortage of properties available. I think there's still around 1,500 to 2,000 properties available in Perth, which is just ridiculously
Wow.
low. And I looked last night. This is according to the REWA stats. There's almost no land available for sale as well. So any land that's getting sold. So there's not a lot of new, still a lot of not a lot of new properties coming on the market, which is one of the issues I see with Gosnells potentially. So you need to be a little bit mindful of that. First-time buyers looking for stamp duty concessions, 5% no LMI. There's still, these markets are still very affordable given the high income they're achieving. So Mandurah, 550 median house price. I looked up. There's not a lot of selling for 550 at the moment, to be honest. So you have to days on market 32 days. So it's come up a little bit in terms of, I'm looking at realestate.com data, as in the suburb profile. So that's where I'm getting those numbers from. Yield is 4.7. So it's not amazing yields. And vacancy rate is under 1%, which are you looking at Mandurah now, AJ?
Yeah, I'm looking at Mandurah now. And then it's funny because you break down, like, just to prove the data point, you type in townhouses. Oh, I might not be able to prove there might not be enough supply. But yeah, type in townhouses and then you type in, let's go 4. And then you type in houses under 200 square meters and we've got 6. There you go. So is that a townhouse? Yes, it's a townhouse. Is that a townhouse? Yes, it's a townhouse. Why have you listed it, Mr. Real Estate Agent, as a house? So you can see how the data is getting skewed. Oh, that's a house. No, that's just a little, like a duplex breakdown.
Yeah. But yeah, so I see that. I'm not saying that, like, so these properties at 500, 550, 600, they're very unlikely to double in the next 3 to 5 to 7 years. So this is, so that's one of the challenges I see or have concerns with this market. It has seen that considerable growth already. The thing that's going to keep it going is, yes, it's still pretty affordable, and it's just almost no supply in the market, as we've just seen. So similar story with Gosnells over there, 530K, 24 days on market, yield is 5.4, so a little bit higher. Look, I think that was about 7.5%, 8% a couple of years ago. So the rents have not kept up with that in that location. And the vacancy rate is a touch, and this considers all dwellings. So look, renters or owners is a little bit concerning Gosnells. That's something I'd be a little bit mindful of. But it's still growing about 15% the last year. So if you want to buy in Perth and your budget's under 650, getting a house is you're basically buying land value at 650. So you need to be mindful of that if you have the money to go into it. Who it's likely to fit, someone with a more mature portfolio. So if you've got already capital growth properties in your portfolio, you'll still see some growth. And I'd say that it's a more cash flow conscious investor. So that's the first. We're going to go around the grounds. I've got Perth, we've got Darwin, we've got Sydney. So there is some affordable properties in Sydney. Somebody asked that. Look, it's not houses, by the way, for under 650. And then we've got Tasmania. So I'm going to talk to that. But Joe, do you want to give us a bit of insight as to Perth, what you're thinking about there?
Well, yeah, I think it would be good to like, the way I'm thinking about this is the dilemma, right? Like, what is the $650,000 dilemma? And really the two options are, as we've kind of discussed, townhouses and the regional markets. And I think it would be good to break down who a townhouse fits and who, like, the regional market fits as well, you know, because there is a certain type of person that is going to be better suited to a townhouse because they're too scared of the risks involved in going regional, for instance. One thing to note, we've already talked about townhouses and the capital growth. What we haven't noted is regional. Now, where are the regional markets? Are they growing or are they going backwards? Right now, this is the home value index for March 2026 for Cotality, which used to be CoreLogic. Top regional markets over the last 12 months. Tamworth, $567,000 median, 17% growth. Armidale, 17.6% growth. Inverell, 17 point, Wagga Wagga, 17, Maitland, 15, Dubbo, 13, Albury, 13, Lower Hunter, Mildura, 17, Ballarat, 14, Albury Wodonga. So these are massive. Where's our Perth numbers there? Bunbury, 21% capital growth on $660,000. What's this? Wheat Belt was 516,000 times by 17%. It grew around about $90,000, $87,000, $85,000 over the past 12 months. So buying regional kind of is working right now. But what you'll start to see, even expensive regional, like $1 million for Lake Macquarie, it's grown 11%. So that's grown over $100,000 in the past 12 months. It's
so Joe, on that point, because I originally had the preconceived idea it would have to be regional of under 650 if it was in WA. I looked at Geraldton and I looked at Bunbury. I looked at a suburb that I thought, or a location. I looked at Withers, which is if you're in WA, Withers is quite rough. There's some quite famous AFL footy players who came from there, and it's rough as guts down in Withers. And I thought, I looked at the data now. Yes, Bunbury is still performing quite well, but it looks like it's starting to taper. And I just thought, well, okay, if I'm going to put my money, like my under, because you can still buy there for 550, 600 roughly in Withers, not in Bunbury, this is like a big rougher part. Geraldton, similar story. I'm just starting to see that the gloss is coming off those particular markets. They'll still probably do 10, 15, 20% in 2026, but I just wonder, are these then the markets to continue buying? And what happens once they sort of start to slow in these particular markets? Do they sort of go cold for years? And that's why I thought, I didn't think it was great. And for full disclaimer, I don't own properties in any of these locations we're talking about tonight. Personally, that is. Oz Property may own locations in some of these areas. But that's a very good point, because you also have to do the micro and macro breakdowns of the data for these areas to make sure that they're still long lasting. An area like Maitland may grow 15%, but it may not continue to grow. So what I would do if I was just starting out, I've got $650,000, I would be going through this list and breaking down like, okay, great. Well, what has the most strongest fundamentals for me? And then looking at the supply and demand dynamics to see where the opportunities lie in a list like this. And as you can see, one of the areas that we're going to chat to later on, Wagga has done 16.9% capital growth. Jeff, what type of person is getting a townhouse over a house? Like what would their kind of considerations be, or the type of person that would make that choice? How would you think about that? I'm gonna answer this. So Rebecca's asked a really good question in a roundabout way. She said, is that yield taking things like body corporate through as well? So that is always a gross yield, Rebecca. So that's the thing that those that focus are too focused or are very focused on yield. You need to look at the net yield. What is the body corporate? What are those additional funds that you need to contribute to it? So those people that I suppose are buying that is that they want to buy in a certain location. Let's just say Sydney. If I've got a $600,000, $700,000, $800,000 budget, it's very unlikely these days you're not going to find. So I've seen people buying for that 800,000 in Sydney, 900 in Western Sydney, and they're buying one half of a duplex. They're not buying a house. So those are the people that have a very specific location set that they have to buy Sydney, they have to buy in Brisbane, they have to buy in Perth, and it's like, okay, well, we got 600. You're probably not going to buy a house in those locations. You need to compromise. So you really need to. Those are the people that I'm seeing, or that you're heavily you need it potentially for a loan, but you should be able to sort of squeeze to a different lender if that's the case. So I wouldn't purely buy it purely because to qualify for the loan a certain lender. There's probably other options out there in the market for you if you need a yield. So those are the kind of people that usually. Sergey's asked a good question. Where would you buy before we move on to our next location? We'll throw to our sponsor as well. But he said, where would I buy in Perth, or where'd you buy in Perth for $850K to $900K budget? And to be very honest, Sergey, sorry, I've butchered your name. I want you to answer that question, Joe. But my answer to that is I probably wouldn't be buying it Perth for that budget unless it was an owner occupier. Because for me, if I had that budget, if it was my first property, maybe. But actually, if I was just diversifying into Perth and I had to buy. If you put a gun to my head, I'd be really trying to squeeze somewhere north of the river. Like, I don't think I'm getting anything in Kingsley or Heathridge. Somewhere like that is where I'll be placing money into a market where there's going to be demand in the fundamentals are going to continue to stack. Probably not like down sort of south. Look, you'll still see some growth there, but I would be placing my money in as best of an asset north of the river as what I could be. Like a Heathridge, a Belden, Craigie, look, maybe we're dreaming in those locations. Definitely not getting Ocean Reef or anything like that for 8 to 950. But those would be some ones that I'd be looking to. What are you looking in there, Joe?
Yeah, this is just the Heathridge property market. 835 median house price. I think it's going to be very tough to go out there and get an $853,000 purchase price. I think it's going to be very tough. And then you'll see the unit market lagging like they're behind. So yeah, it would be a very tough market to get in. The challenge you've got with the Perth market, this market here in 2023, so just 3 years ago, was $560,000. It's now $853,000. This market has just run a marathon. This guy is sweaty. He's exhausted. He's just run a full marathon. And guess what? The property market never stops. So we're going to say to this guy, you've got to run another marathon, mate. So this guy's now got to jump back on put his running shoes on again and run another marathon, because we're not buying for the next 1 year. We're not buying for the next 30, the next 90 days of this, war. I don't think it'll be 90 days. It's probably going to be a couple of years, to be fair. Anyway, you're now asking it to do. So I'd be looking at markets that haven't run a marathon. I'd be looking at more of the markets like your Victorias and regional New South Wales, things like that kind of haven't run their marathon yet. So that's one way to think about it. Just going back to townhouses versus units, because Jeff has been doing the area research, and that was what I was meant to be doing a little bit, but more of, I've just kind of dived in a little bit deeper into the townhouse and regional market, because I think it's an interesting shift that is hidden away in the data that people don't know about. But the way I think about it is, if you want land content and you don't mind buying an ugly duckling property, and you want to potentially add value to that property somehow, be it renovation or subdivision down the line, then a regional house on land is going to be the way to go. If you're a set and forget buyer that just wants to get an investment property rocking and rolling, doesn't want to do the headaches of value add or things like that, and you really like the idea of being closer to the CBD, like your Brisbane middle rings or your Melbourne middle rings, then a townhouse is probably going to be the better option for you. So it does come down to overall net return, but it also comes down to overall investor return and who you are, and what you actually need it to be. One other thing to mention is, we're going to talk about regional locations or townhouses. It is not buy a townhouse in a regional location, because the supply and demand metrics are the inverse, because there's so much land out in regional that you want to be buying the product that people actually want, which is an established house, which there's a little bit more of an abundance of, rather than a townhouse. Will the townhouses still grow in the market? Yes, but you need to be picky about the markets that you choose. Thoughts on that, Jeff?
Here we go. Haley, I do have a treat for you. I do have some 650K in Tassie. Tassie is probably one of the, but I've got some detractors in Tassie. But we'll throw to our first sponsor. We're going to go up to Darwin next, and then we'll sort of float into Sydney. And I'm going to absolutely have to rip through these, because we're trying to keep the session to an hour. And I want to do the bonus. So if you want a location unpacked, let us know. But first ad.
Go on.
They said a savior would come. One who could see value where others saw fear. A buyer's agent who could turn data into destiny. Behold, Joe Tucker, an award-winning buyer's agent of Property Principal.
Whoa, what is this? Next thing you're going to see is driving off in our Lamborghinis, throwing cash about. You guys know Jeff and I, we don't really like to roll that way, right? We've been running this group for 5 years. We've been sharing all the data, all the strategies, all the tools, all the tips, all of the tricks that work in today's market to secure the best deals. But here's the thing though, if you're putting a part-time effort into something, you're going to get to a part-time result. And that's no difference with property, right? If you're dropping $500,000 to $1 million on property, this whole she'll be right attitude gets pretty expensive. What is the hardest part about building a portfolio? It really just comes down to time, knowledge, and execution. So if you don't have the time, you don't know what the heck you're doing, and you're afraid you're going to mess it up, then don't do it. That's literally why I do what I do. Most people don't even realize this, but I'm actually a buyer's agent. I run Property Principal's buyer's agency, and we have helped hundreds of investors get the right properties in the right locations so that they can scale their portfolio to $150,000 of passive income or more Because why? Because we follow some core principles. We use a lot of data to pick the right locations. Think about it, the hot spots before there's ever heat. We get boots on the ground in every single location that we buy. And I have been there, checked it out, and approved the area. And we only buy in areas, and we only buy properties that we would want in our own portfolios. And that's how, in 2024, last year, we got a 21% growth across all of our client purchases, when the national average was 4.7%. For instance, Matt and Tina, a young couple, they bought 3 properties with us. They've built over $768,000 worth of equity, and they're still working full time. No dream selling here, but I tell you what, they're going to have a killer retirement. Phil, he's a young kid. He's just bought his first property with us. He's now on to his third, which is super exciting. He bought the first one, $595,000. That is now worth $770,000. He did a great little renovation up front. It's now grown $175,000. That's nearly 30% growth in under a year and a half. So it does take a little bit of time. Gosh, it does get there. Yes, we've had some big wins, but it's not an overnight get-rich-quick scheme. This whole property game is about smart, strategic decisions done well and taking the action. So I'm not here to sell you the dreams, but if you're ready, book in a discovery call. We can chat about what your next move is and if we can actually help. Let's do it.
Let's do it. Baby. Indeed. Let's go. So what do I want to say? Because I'm going to read through, because you got Wagga, mate. You got about 40 hours research on Wagga, probably. You did.
No, I don't want to share too much, because it might be a really good location where people should be buying, or it might not be. I
definitely been buying there. Trust me, I've seen a few, but not. But so okay, next one. I'm going to read through this one. So Darwin. Now this is I'm going to throw
Darwin.
Yeah, this is because if we had Kirsty Mattiazzo on the show in November 2024, I saw big potential in it there, because there was just incredible demand that was coming. It was undervalued. People were looking for that spot. Anyway, the time's moved on 15, 18 months. So it is grown. So I'm going to throw out the suburb. So Durack. So this is really a 1 to 3 year play. This is you trading property. Now, I don't know whether I believe in that concept of trading property, but if you're looking for a 5 to 10 year hold, I would be cautious, very cautious of this market, because it has grown around that 20% over the last 12 months. And it is the things I don't like about Darwin. Look, there's a lot of, I suppose, investment in resources, and look, there's plenty of stuff happening up in Darwin at the moment. Surging construction infrastructure, growing manufacturing, it's all happening there. Look, Durack, the median price for a house. So we're looking at a house here of $630K. So you're potentially struggling to secure something at $630. The yield is still 5.5%. It was about 6.5%. 28 days on market, 1.3% vacancy rate. So it tells me there are definitely investors that are looking quite heavily into that market. So I would say if your risk tolerance is a little bit higher, there's Diver and Grey, which is on the left-hand side of Palmerston. You'll get in for a cheaper price, but expect some potentially troublesome tenants. So the thing, who it's for, as I said, this is somebody looking to trade property, unlikely to be a consistent performer over the next 7 to 10 years based on, look, it may go for 3 to 5 years, but this is not a market you come back to, you go to sleep and you come back and look at it in 10 years, because yes, it'll probably generally go okay. But those are my views on a under 650K in Darwin, which you just need to be a little bit cautious of that one. What is this? We're looking at Darwin here, are we?
Yeah, well, this is looking at Darwin right now from a data perspective for dwelling values according to CoreLogic, Cotality, and just look at that bump up like that. No other. Perth actually has had a very similar bump up.
More consistent though.
Yeah. But it's also the volume of data as well. Like it hasn't got the same sales volume, so it's going to be spikier rather than a smoother line that has more points. But yeah, look, I guess the challenge that is with Darwin is the macro fundamentals backing this. There are very few reasons, and there are very distinct few reasons why this market has done this, and there's a few reasons why it may not continue doing this. So the way they talk about it is the bull takes the stairs and the bear takes the window. So I would just be kind of cautious of history on this one. It's absolutely crushed it. Darwin has done the most amount of capital growth so fast, so quickly. If you jumped in here when everyone was, it's just like every other market. People are telling you it's a terrible idea. This is the worst decision of your life. You would have absolutely killed it up 30-40%.
I was pretty convinced around
so
sort of
convinced,
mid-2024. But but having said that,
should have bought it. We should have bought the Oz property portfolio. We bought 5 properties. That portfolio, by the way, over 18 months has grown over $600,000 already. But I should have listened, Jeff. I should have let you.
It's okay. No. But it's for a specific brief. I'm starting to see.
Yes.
Maybe not Tassie is going to be the new Darwin. It won't be. But just quickly, so I'm going to quickly rock on to the next one. Then we're going to go across to Joe and Morga, and we're going to round down in Tassie. So stay tuned for Tassie, because that should be an interesting one, my take on that. So this is, if you're Sydney, if you think Sydney is king, if you absolutely have to have the queen in the piece of the chessboard. Look, I've got a little bit of something for you under 650K now. This makes me feel a little bit, not necessarily uncomfortable, but units. I don't know if I necessarily absolutely love them, but they do serve some purpose I'm seeing more and more people starting to transact on units. Now, you need to be cautious of strata. You need to be cautious of supply. But the one that some people were speaking about this in the group 12 to 18, 24 months ago is Lakemba in Sydney. Now, if I'm Sydney born and bred, so I know Lakemba, I know Punchbowl, I know these areas. They are very working class areas. So you need to have a good property manager if you're going to even consider this. And I would only be considering those 8 to 12 unit blocks, not the 100 sort of brand new shiny objects. You need to be careful on those. So you need to be very discerning in these sort of markets. But if we look at it, it's done about 15-20% over the last off a lower base. So you could buy something at 440 about 12 to 18 months ago. Now the median price Canberra is about 530. So 32 days on market, 5.5% yield. Yes, you have 1.4% vacancy rate. So that's a little bit high, but I would say that considers all dwellings as well. The things that I don't like about this area is higher renter to owner ratio. So we're talking like above 50%. So heavily investor driven market or renters in that market. In pockets, it is rough in Lakemba. I've driven through the suburb. No friends and family lived in the area, so potential supply could be built and lower socioeconomic. So those are the things potentially that detract us from the area. It's an investor who is looking a more mature portfolio, probably first timer. Unless you absolutely have to own something in Sydney, I don't necessarily know this is where I'd be placing my money initially. But it's unlikely to go from 500K to $1 million in the next 5 years, for example. The reason why people are starting to see value there is because the median house price in the Lakemba is around 1.5 million. So we're talking a ratio of 3 to 1. It just was so undervalued. It can only stay up for so what. And one little tick away. So now that I've talked to that, Joe, what are your thoughts on Sydney anyway? Would you pick up a unit or a townhouse in Sydney, or is that a no from you?
It's not a no. It really just comes down to the opportunity, right? Like, I just think there's better opportunities, one in regional and one in townhouses in other markets. So I'm not saying I wouldn't buy it. If someone was like, hey, Joe, there's a townhouse in Sydney that next door just sold for, $620,000 and you can pick this up one for 540. Well, yeah, I would probably do that if it all stacked up. But it's not my first pick. But I definitely see what you're talking about. Like, I can see the value there and why people would want to do it. And then it comes down to the new stock coming on the market, then the affordability of the people to go there. It's kind of in that transition phase of what we were talking about between house prices and townhouses as well.
Yeah. So this is an interesting one. I like this one from Kerry. This is the way you kind of should probably be thinking about the portfolio pigeon pairing. Like, what are your thoughts on high yielding old units with low strata? That's probably the ones, if I was going to put any money in for those with a significantly negatively geared portfolio, well, if those I would sort of take a step back and say, the negatively geared portfolio, is it actually growing? So is it serving its purpose? Because if those properties don't have high growth potential, you might want to sort of think about, well, are those still the properties I want to hold? Because why are you 20, 30K negative per property if that's what it is? So they can serve their place, Kerry, particularly where you're using structures. What are your thoughts on that one, Joe?
Well, I guess townhouses and units follow a similar avoid list. So this is what you have to do to avoid these rubbish opportunities. One, avoid complexes, massive complexes that have 20, 40, 50, like 100 plus units or 20 plus townhouses. What we want to be aiming for are townhouses on a single, plot, and then unit blocks of like 20 and under. So avoid gyms, pools, spas, those types of ones, because there's no scarcity, right? Like there is always going to be multiple units up for sale. There's always going to be multiple units up for rent. You've got massive communal fees as well. So if the pool breaks, yes, it's divided by 200 people, but you still have to keep giving into that money. So the things still stick. Land content. So if you buy a block of units, a unit in a block that's on 1,000 square meters and there's only 20 units, that's going to be far better than 1,000 squares with 150 units. So we still want to get that land content. That's why townhouses are more expensive and more valuable than units. So that's something to notice. The other thing is if you're buying townhouses and units, don't go to areas that are high family concentration, right? So I was doing a little bit of digging into it before. Area like Craigieburn. So Craigieburn is north of Melbourne. It's 50 minutes or so away. I don't know the exact driving metrics, but 84% of those people that live there are families. So a 2-bed townhouse or a 2-bed unit is not going to be the product that these people want. Now, in a decade, way more than a decade, in 50, 30 years, maybe it'll be like Sydney, where getting a townhouse for $3 million is kind of what you have to do. But that's one of the things that I would avoid. Don't go and get super families. You want to have single people. You want to have people that want to live by themselves. You want to have not kids, but 20-year-olds starting out for their first purchase. That's the demographic that you want to attack for it. And tight vacancies.
Yeah, exactly. That's you need to be mindful if there is a higher renter to owner percentage sort of ratio, then you may end up in a situation where if there's a lot of properties become vacant, then you may have to drop your rent. So if you're factoring in a 6.5% yield, and then there's more vacancies come up, you may have to drop that to entice a tenant to take your property. So just be mindful and cautious of that as well. That's another reason, part of the reason that you talked to about, the difference in suburb prices. So Lakemba is surrounded by, you've got Croydon, you've got a couple of other sort of suburbs that are more prestigious, at least if Croydon would be, and units in that sort of places are 700, 750, and maybe it's arguing that the quality is potentially better or the newness of them. But I sort of saw that, and that stood out for me a little bit, why there is people that are flocking somewhat to these properties that are affordable, first-time buyer grants, stamp duty concessions, all those things are contributing to the reason for the growth in those assets. Joe, Wagga. What's going on in Wagga? We're talking to Wagga now as well.
We're going to Wagga. We're going to start talking about that place. Super interesting. Like if you look at it from a macro fundamentals, I don't want to say this, but it doesn't make sense that it's at the price that it's at. It's undervalued for a regional market. It's got 70,000, around about 70,000 people that live there. 2036, that's going to be at 80,000 people. Renters to owner occupiers is 61% to renters. So there's more owner occupiers, which is really good. But the economy is super diversified. Like this is not a one-horse mining town. The unemployment rate is at 3.8%. They've got manufacturing that generates $1.4 billion, construction. They've got agriculture. They've got education. The
sporting as well. Big sporting sort of things in
bloody what's it? Charles Sturt University equates for 7.9% of GDP growth. So the hospital just had a $450 million redevelopment, which is now setting it up to be really, really interesting. They've got $15 billion infrastructure pipeline going over to there. But don't get too excited about Wagga. It's not worth buying in. That's what I would say. No.
Is there any particular pockets of Wagga that you see? Because I know that there's 900, 950, $1 million suburbs in Wagga, and then there's your sort of 500, 550, 600. So is
Yes.
there is there any secrets that we can?
So there's areas to avoid or consider. Tolland is an area that you should think. High vacancy rates there, and a lot of social housing concentration. So if you're thinking about that, just kind of think, like it is 500 and high 500s for a property there, but you just really, really need to be careful of that. Ashmont is another one that you need to be thinking about. It's more affordable. Vacancy rates are at about two and a bit, but that's one in pockets where you should be worried, and then in pockets where it's like, oh, actually, there's a new development there that looks really good. That house is starting to gentrify, so that's worthwhile. And then Mount Austin as well is one of the most affordable places there. High rental yields, which is really, really good. But yeah, just again, watch out. So it's not so much there's no-go zones everywhere. So that's just something to be aware of. The market's absolutely crushed it. As I said, we saw it in the CoreLogic data just before. It was 16.9% capital growth. So for a regional market, it's a major regional hub. The way I like to think about it, I was literally just chatting with an investor about it the other day. It's there. It's by itself. It doesn't need anything else. You know what I mean? It is the satellite that grabs and attracts all of the other areas to it because it's got the big Woolies, it's got the big Coles, it's got the big Bunnings. It's set up to be by itself. Oh, I don't want to buy out there because it's the middle of nowhere. A lot of people like the middle of nowhere. And it's there to be services everything. You don't need to go to Sydney. It's in between Sydney and Melbourne, by the way. We should have brought it up on the screen. But yeah, from a data perspective, look at that. I've already Albury to Wagga Wagga. Albury's another area that almost made this affordable $650,000 list. The problem is it's so difficult to get $650,000 in Albury Wodonga. Don't get me wrong, it's possible. You can do it, but just be a little bit, just good luck. But here's where Sydney is. Here's where Melbourne is. Here is where Albury Wodonga is, and then here's where Wagga. It's called Wagga Wagga, but it's so good there they had to name it twice. But yeah, so
call it Wagga. Somebody said thoughts on Mount Gambier. So we haven't given a lot of love to South Australia.
We haven't.
Mount Gambier, it didn't come across my radar. I know a lot of people still talk about it and are interested in it. A couple of weeks ago with Marcy and Jason, we spoke a little bit about Mount Gambier. It has the lake. Look, I think there's still some potential there in Gambier. It's just, is that sort of what purpose are you buying for, and all that, what kind of time frame, etc. It's the same reason I probably wouldn't have included Geraldton or Bunbury. It's like, how long is the market going to continue to grow? As long as the demand, I suppose, keeps up in supply. Good morning from Lakeland in Florida. Wow, Kevin. Well, thanks for joining us. Good. Hello. Hope all is well in over in the US and in the States. So, Joe, we'll get. I'm going to quickly cover off, and this is probably the one I should have mentioned first. It's
actually just before you do, Tassie. Actually, that's a great point. Troy made a really good point that I didn't touch. Yeah. I've got it in my list as a negative, but I got too excited. My only concern with Wagga is all of the new developments, Estelle, etc. Spot on. That is another huge consideration that you need to think about.
Down that way, I sort of, and there's potentially some issues with the soil as well. I hear. I don't know if that's in Estelle, but definitely some issues with some sinking soil down that way.
Well, yeah, it's crazy. That's one other negative downside that you need to be aware of. And yeah, that's pretty much just what I wanted to say.
Good old Jim, man. I remember last week, Jim's on it. I think he's bought a property or two. It has tripled or quadrupled the last few years. Replacement costs, Craigieburn, could be worth considering. Yeah, I mean, maybe I'd have to really dive a lot deeper into Craigieburn in terms of townhouses and all that sort of stuff. I think that.
Well, literally, I just said Craigieburn is no for townhouses because it's got an 84% family. So 84% of that population are families, and there are abundance of houses, and there's new developments that can happen, which is a little bit different to the Logan setup, right? Like a lot of Logan Woodridge fully built in. You can't build anymore. It's super affordable. That affordability is going to be pushed into townhouses. Craigieburn, they can keep developing. There's still heaps. So I would just be a little bit cautious. Not saying that you're not going to make money. You might be able to pick the winner, but just be careful.
There we go. Okay. Tassie. So this is the one I see so much interest. Jeremy said he's got 30 clients have bought in Tassie. And I think some of them this location. Why? What are the things that's got Tassie or Hobart in particular? Because I didn't go outside of Hobart. I know there's Launceston, I know there's Devonport, I know there's Burnie. There's all these regional centres around Tassie. Joe, you probably know Tassie a lot better than me, actually. To be honest,
I used to live in Tassie. I lived in
exactly.
Tassie.
That's why you probably know it a little bit better than me. But the Hobart City deal, which is $2.5 billion, which is investment into the region. I didn't see. So it's the Bridgewater bridge replacement. So I'd just be cautious of getting so excited about some of these things, because
don't get excited about the Bridgewater bridge getting done. It was a gross bridge.
The reason I got excited. Sorry,
it's a gross bridge.
It was one of my suburbs.
Okay. You can get excited about that. The data for Bridgewater is very, very interesting, and it is a very Bridgewater Tas. The data is very interesting for Bridgewater. The social demographics of Bridgewater
are interesting.
And it's not to say that doesn't grow. Armidale in WA, very low socioeconomic and very, very difficult.
I wouldn't even say, like, this is 20 minutes, half an hour outside of Hobart, isn't it? So is this even still Hobart, Joe? Because
I wouldn't consider. No, it's not considered. It's not considered Hobart, but like it's a part of Tasmania. Like, it's close enough. It's only 30 minutes, 20-minute drive.
Yeah. But the thing that's how about Broken Hill? People are just trolling Michael Solara. So good. I hope you're okay too, Michael. But yeah, so the things I like about it, you got Macquarie Point redevelopment, stimulating the local economy. I know that you're laughing at me because you actually know it.
No, I wasn't laughing at you. I just saw this comment come up and it made me laugh. A property without sewage connection worth buying.
Well, how much
do you shit time, isn't it?
Shit. Pushing up shit creek.
Sorry, go on, Jeff.
But no, so the other thing, you got that the Tassie Devils are coming into the AFL. I had to mention the sporting reference. The thing I don't like about Hobart and Tasmania is the population growth. It's almost non-existent. Like there's like 2,000 or 3,000 people that got added to the population. So I just don't like, what is the sustainable longer term? And another detractor for me, before I talk about some of the suburbs, is what is the, I suppose it's grown considerably, and is it actually affordable for the locals? Are people still wanting to live? And sure, if you live in Battery Point, as the Salamanca markets, they're amazing. But this is definitely not Battery Point where I'm going to be talking about now. This is even beyond Glenorchy, which Glenorchy is considered rough. As where you
beyond Glenorchy.
Yeah, because Glenorchy's on the other side, and look, there's Moona is quite nice potentially. There's some pockets there that are good. What's happening though is people are getting pushed out of these areas, and they're having to go further and further. Now, whether it's investors or owner occupiers, but I think so. The areas I'm going to mention here are Bridgewater. Now, I know there's a lot of maybe buyers agents. So I just want to say that a lot of investors or people that are suggesting these are locations. 480 median house price. Days on market is 24 days according to realestate.com. You've got 5.7% yield. So the yield is, and this is for a house as well, 0.7% vacancy rate. So the thing I would say is the renter to owner ratio is about 55-60%. So a lot of investors are buying up in these areas. So just be a little bit cognizant. And it's also grown about 50-60% since the start of COVID. And probably over the last 10 years, it's done about 150%. So is it going to go to 700,000? I don't think so. So this to me is almost, I lump it somewhat in the Darwin market. I'm not saying that I'm not liking them, but I'm saying if I had to pick a similar market, you're going to get maybe a quick sugar hit, 2 to 3 years of growth. So this is probably not a 5 to 10 year hold.
What's the median house price?
In Bridgewater, 480K. So you would think it's affordable, but it's 35 years to own at an ersat of 1. So the socioeconomic status is very low in this area. And so look, it's going to be a top performing market in 2026. It's already sort of showing it's grown 15-20%. So it's seen good growth already. Herdsman Cove is a little bit cheaper, but there's not a lot of properties there anyway as well. Not a lot of transactions. So yield is 6% in Herdsman's Cove, just up the road. So, but it's very hard to secure properties there, what I'm hearing as well. So,
well, the challenge is because the market is made up of so much housing commission and rental market. Like it's like this here, this pocket is 30% owner occupies. So one in 7 houses is a housing commission or a rental. So it's already a small pocket. The actual stock levels of investment grade worthy properties there is going to be a little bit difficult. I actually am going to kind of not disagree with you, Jeff. I wouldn't dare do that. But I actually think this market is going to do quite well. Like it is.
Oh yeah, I'm definitely not disagreeing. I'm just saying
I'm just a little bit worried about the type of tenants that you're going to get. It's going to be a little bit harder from that. But if you are at $650,000 and below, and you are willing to deal with a difficult tenant, you don't want to get a townhouse because you don't want to be in the city. Like you don't have much choice, and it is a gamble worth. I bought in some of the worst places in Brisbane, some of the worst places in Melbourne for my first couple of properties, and they've performed well. Have I had tenant difficulties? Absolutely. I had a place I had to pay $12,000 and their bond was $2,000. So yeah, but I mean, just be careful.
So do we like it, Joe, or
am I giving it a thumbs up, mate? You put it there as a like. I'm going to say I think it's going to do quite well. The data's back. It's a hard market to get into.
Oh, very hard. Yeah, incredibly hard. I wanted to call this question out from Jeff because his name's Jeff and he came to the Oz Property Insights event. He said, given the market is clearly shifting, would you consider adding a lower end commercial property to Oz Property to offset the negative cash flow? Mate, this is why we've done this session, Jeff. We're talking about those more affordable, the higher rental returns to offset that, because you don't want to be tone deaf. Like, yes, it's great to have good incomes, given inflation is clearly rising and that most commercial leases incline with CPI. Jeff, it's an interesting point you raised there, and I want to get Joe's take on this. We'll throw to a sponsor, and then I want to do viewer's choice. It doesn't have to be under 650. We can throw those comments in. My views are that's also a risk, Jeff, because you imagine what struggles in an economy where things increase. Businesses can struggle. Because if they're not getting people buy stuff, if they're having people hold it, maybe you might lose a tenant. So I don't know. It's a 50-50 on commercial property, particularly at low end, because if you've got that business that's only new. What are your thoughts on that, Joe?
Yeah, I think you nailed it there, Jeff. I think it depends on the price range of what the asset is. If you're buying, like exactly what he just said, if you consider adding a low-end commercial to the Oz Property portfolio, one, we don't really need the cash flow, so it's not something that we need to do, because when we accept cash flow, we're deliberately rejecting capital growth, and we're not in a position, we don't need to do that. But the problem is we also don't have enough equity in the portfolio. We have $600,000 that we've gained. Congratulations. But that's still not enough to buy a $2.5 million commercial, which is where I would be seeing the value for commercial. And, I'm not a commercial expert. I don't go out there and buy commercial. I've never bought commercial. So don't rely, 100% on what I'm saying for commercial, but it's just how I think about, how I think about it.
Okay, let's seeking commercial. That's a nice little pivot. Thanks, Jeff, for helping us into our sponsor. So throw your suburbs and locations. I'll read through as well. I'm dobbing to Palisi, hating a commercial. Palisade. Gee, the Palisades. On that note, let's go to that and let's get back into
autocorrect.
Q&A.
Oh, Jeff, I wish there was 3 investing books that covered everything property.
Oh, Joe, there is. Steve has 3 books now.
That I do, guys. I've got 3 books now. You probably don't even have to follow this group anymore. Just kidding. You want to keep seeing and hearing from me, of course, so stay involved. But in all seriousness, if you want to get the full picture of investing, residential, commercial, and development, these 3 books have you covered for the fundamentals. For Oz Prop members, here's the best part. I'm giving these books to you for free. Just cover the postage and I'll send them right to your door. Go to policeyproperty.com or click the link below and get your copies today. You can also get all my spreadsheets, checklists, and resources free on my website. Happy reading, gang.
Oh, people aren't happy we skipped Victoria, Joe. Bloody hell.
Did we?
Well, the reason, because Victoria is easy to do. Like, we could have just done like where to buy in Victoria for $650K and we would have had 5,000 people watching. So that's why Elliot, I'm being a bit crass, but in all seriousness though, look, let's talk to Francis has brought up a really good, interesting point. And we know Francis is a friend of the show. Have you touched on Ballarat? I came in late. Joe, I've got some views, but what do you think about Ballarat? Do you like it?
Oh, definitely. I think there's great opportunity in Ballarat. We did a great session on it a couple of months ago, maybe now. I think it was just before Christmas. Yeah, we dive deep into the Ballarat and the hot spots and the not spots. There's a lot of northern pockets of Ballarat where it gets really high housing commission. You really need to be careful there. One thing to mention as well, I don't know what the median house price for Ballarat is. I haven't got the data up right now.
Yeah, it varies quite a lot, doesn't it?
At 650 mark. Very hard to get. Like, it's kind of like that Albury Wodonga market. The median house price is 650,000, but getting one under that is very, very challenging. That's actually worthwhile owning. If you're willing to compromise on housing commission and rent a percentage and buying on a main road, absolutely you can buy a dud there, no problemo. There's definitely value there.
One's if you're looking in Ballarat, like you go sort of to the south, and there's a little bit in the south. There's Sebastopol and Eaglehawk and all those sort of places. I would say that yes, I think that's probably where a lot of investors have bought. I imagine, Joe. I haven't looked at the rents to the owner percentage. I haven't looked at the housing commission, but that's where the more affordable pockets are. But there's just
Wendouree. Gills. Was it Gillis Street? Just be very, very careful of West Wendouree. It's rough. It's a don't go there as in buying, but it's also don't go there at night. Like, no, I'm kidding. Sorry, West.
And I just think I'm seeing prices in West Wendouree, but I just wonder if people are aware of what they're actually buying into. So I'm seeing some interesting transactions around that 500, 550, 600, and I'm just like, okay, crap. And then one street over, so maybe it's literally street by street in West Wendouree, but I struggle to think that in one pocket it's 400 or 450, and one street over it's 550. So just really go in with your eyes open in some of those pockets of Ballarat is what I would say.
There's also some developments, not developments, but like there are some pockets of places where the quality of the dwelling is just really not good. It's like 115 internal squares, little kitchenettes, like they kind of they try and sell them as these like rooming houses. But there's a lot of developments where they're just super small. So just like the market does 80% of the heavy lifting, right? Buy a property in a good location, and it doesn't matter if it's got a busted up kitchen because you can replace that. It doesn't matter if it has this. It doesn't matter if it has that because the area is going to grow. Wagga Wagga grew 16.9%. The house is going to grow well as well, but you need to just choose it, not like in the terrible spots. But you also just need to factor in, like when people are like, well, screw it. If the area just grows. Yeah, but if you buy in a high housing commission, you're just going to deal with a lot of tenant issues. You're just going to deal with a lot of stuff that you just don't need to and you don't want to be dealing with as a busy professional. How do I know you're a busy professional? Because you have double incomes, you have a job, and you're able to afford borrowing capacity. You have a full-time job. Don't worry about this stuff. Don't stress. It's just don't mess it up. Don't mess it up.
Yeah. So this is an opportunity for you to ask. We're probably going to wrap up in about 5. So if you want, there's been a couple of locations. Another interesting, if we want to go around the grounds in regional Vic, Bendigo is another interesting one. I know we don't want to. I'll talk about very briefly, Joe.
Okay, you go, man.
Golden Square, I know, is seeing a little bit of interest, and I know some people who may already have some deals there. Look, White Hills is not under 650, but yeah, and that's chalk and cheese. There's some pockets there. Joe, Geelong. We don't want to say the word too much because it's already very hard, but man, Nor Lane is absolutely going gangbusters at the moment. So, but we won't. I've already talked about it.
I've got property in Nor Lane. I'm happy.
So I said I personally don't own. I mean, Oz Property might own it.
Yeah. Yes. Yeah. We do definitely own in Geelong, but it's just a clear winner. Like I don't want to pump it up because it's got so much demand there already. Anyone that's trying to buy, good luck getting a half decent property. You've got to have the connections. You got to be chatting with the real estate agents. You got to be able to get access to the stuff before anybody else. But it's a challenge. It's one of the hottest markets that I've seen in a very long time. But it's good. That's a good thing. It means there's going to be growth there. And just kind of circling back to what we were speaking about before, like taking action is the most important thing here. Like every time you sit on your hands and 6 months ago you didn't buy, you've been thinking about buying, you just got to do it because this is costing you $60,000. And it's expensive. That's the biggest expense that there is. There's the sit, wait and see tax that is just not heard of and spoken about. And people, they don't factor it into the cost, unfortunately.
Nick me on YouTube said, I'm going to have to rewatch this. I've come late and missed the good buys. Nick me, wait, ask us a question. Shoot your shot now because we'll throw this. If you come to us with a comment in a minute or two, we'll get to it. But I wanted to address maybe a bit of an elephant in the room because it's an interesting one. Because there are some markets we didn't give some love to. What do you guys think about the areas in North Queens, such as Kincora, South Gladstone, New Auckland, and Ayr? So you've called out Gladstone there and Ayr, which is kind of a little bit outside another regional. I was speaking to somebody about Mackay today, and I just said, look, be a little bit cautious about these far North Queensland regions because they're like the rental return still 5.1, 5.2. I said, how about the insurance? How about the council rates? Once you factor that in, you're probably almost buying your 4% gross yield in Victoria effectively. Less. Even with that, maybe even less, depending on how much, if it's in a flood predicted area. So, look, my views on just look at the history now. History doesn't repeat; it often rhymes about what's gone on in Gladstone. Now, has the market matured? Maybe. I'm not 100% confident it has. So Gladstone 3-4 years ago, you would have absolutely made a mod say doubled your money. But now 500, 550, it still fits our criteria. But I just think what happens when if the market realizes it doesn't have as much of a diversified economy as what people are saying it has, what happens then? That's the question I want to ask myself. If it's a short-term buy, maybe. Those are my views. What about you, Joe?
Well said. There you go.
Okay. Looks like Mick, Nick me. She's missed shooting a shot. I'm sorry. Ararat's an interesting one. It's a small. The town is very small. Is my views. It's about 3,000 to 5,000 people, and I just think, okay, great. Yes, you might see investors flood to it because it's affordable. What is the reason you're buying in that area? Is it because it's the rental yields? Same thing with Moe and Newbra and out that way in the Gippsland sort of area. Is it going to see some growth? Yes, it's seen 15-20%. What's going to happen once people realize the yields drop? That would be my question. Affordable, great for now. Is the economy diversified? I'm not convinced on that. Joe, before I give you the last, you haven't.
Well, no, I just think this has been a really good session. I hope it's been valuable for you guys. This is a market, like we don't really talk about this market too much. I think there's opportunity under $650,000 still. I think that's where people get a little bit confused, a little bit stuck. They're like, oh my gosh, there's no opportunity out there. If you like the cost of not like buying the absolute best of the best, if you're buying something at 750, 800,000, that may be the absolute top 1% of the property market right now. But what happens if you get the top 5% of the property market? Is that still not going to beat doing nothing? So I think that's kind of where this session fits in nicely. It's like, cool, well, I can't afford but like the way I like to think about it is we, as investors, we buy the best property in the best location at the best price for our buyer brief. And our buyer brief dictates those three other things. So if our buyer brief says you have to get under $650,000 with a 4% yield, then go out to some regional locations. There are some great buying opportunities ahead. Rates increase. Most will sit on the sidelines. Yeah, I agree. I think that the next 3 to 6 months is going to be a window of opportunity. Exactly like, do you remember, Jeff, when the Queensland government were going to introduce this like land, was it land tax? They had some stupid policy where they were going to tax you on stuff that you had in Sydney.
Your nation. Well, they were going to consider the holdings in other states. So they weren't taxing on that, but they were considering if you own properties in other states. So that's.
But we saw like in the business, we saw a macro shift in how people thought about Queensland for that 3-month period, and then it went to nothing in Queensland. Then went on a tear to crush it. So I just think it's.
I mean, I would be, just make sure you've got your own buffers. Thoughts on Cessnock and Bellbird. Sorry, Edwin, that'll have to be our next session because we're going to finish these on a high now rather than dragging on. But no, that people are still asking questions tells me that it's time to turn the lights on and last drinks have been called. Sorry, Edwin, I gave Nick, sorry, that name's going to give you nightmares. But no, this has been an amazing session. So please, if you want us to cover more content like this, drop us that 5-star on Spotify. I think we're nearly at 50 now. So we're getting there. I said we'd be at 100 by July of 2025. So we're well ahead of schedule, I think. Absolutely sarcasm there. But no, the other thing I wanted to call out. So Friday, give us that 5-star on Spotify. It helps us get the good guests, including ours truly. Friday night, if you're in Sydney, come along to the Cheers Bar. I didn't line this up actually, so I don't have the post. If you've got, come along, send me a message if you need to. Send Ricky Steamboat, send Joe a message actually. But no, it'll be fun. We're going to be there from about 5:30, and I'll be there till about 9:30. Jeremy will be there around that time as well. Joe, I don't know he could be there till midnight. I just don't know. He could be. Just make sure catch him while he's there. Catch him if you can. But
I smoke bomb out of places as well, so like I'll just disappear. There's no goodbyes with me. It's just bye.
I'm saying goodbye for half an hour, and then okay, Joe. So it's been an amazing session. If we've already mentioned you once in the show, but if people want more Joe Tucker in their lives, how do they reach out to Joe?
Mate, these type of assets and this type of market is where we are seeing a lot of opportunity as a business. We buy these investment properties every single day. So if you are looking for a sub 650,000 regional location or a sub 650,000 townhouse, we can absolutely help you. I buy these things. There's good opportunity out there, but like I said, there's 13,690 suburbs with data, 244 of them in the regions that actually have high confidence in data, and there's very few that actually stack up. So that's how people can reach out. Jump on the consultation link. Jeff, how do people get more Jeff in their life if they want a loan? This is the funny thing about Jeff is he doesn't want his business. He doesn't want any more deals. He's a broker. He's a fantastic broker. So if you do need a loan, he will get it for you and crush it. But he doesn't want it. Don't, because he's got too many calls to do. No,
look, I do love it. Like I have these chats like almost 2 or 3 nights a week now because that's when a lot of people are available, and I just enjoy it quite a lot. I enjoy hearing about where people want to go. So I can't promise I'll be available next week, but if it's not absolutely urgent. But if it is urgent, just let me know and we'll go from there. Before you go, let's summarize your top 3. Okay, sorry, Vajinda. Top 3 on what criteria? But I'm going to go short-term growth. Probably the Greater Hobart was where, that's a big call maybe. But if I'm focusing purely on a hotspot short-term growth under 650, Corio and Lane. Sorry, Joe. I know you. And then number 3. Oh, geez, I don't know my third one. That's my challenge. I would probably then be going, I don't know where my third is because I'd have to think about, that's my top 2. I'm going Hobart and I'm
going to say Geelong. Bridgewater is going to do well. That's my Bridgewater would definitely do well.
Okay.
Just good luck buying there. Good session, mate.
Much, everybody.
Thank you very much for taking the time. Thank you, everyone that stayed on. Have a great evening, and we will catch you on the next one. Let's go buy a property, guys. Let's make it happen.
See you, everybody. Loved it.
Bye-bye.